I think a lot of people get upset if reality is not what they want it to be. That's so stupid.
Hmm.
I mean, reality is reality. So how does it work? And how do you interact with it to get what you want?
Is there a principle that we should bear in mind that would protect us from that sort of hubris, overconfidence, overconcentration, trend following, dangerous herd chasing?
Yeah, first of all, I want to say, I can't tell you how many times in my 50 years the exact same things happened. So you kind of know, you smell them, they have that smell to them. But I would say the best thing you could do is go back in history and see the other cases, almost imagine, like everything's another one of those, So I go back to that case and I think, there was the Nifty 50, there was the dot-com bubble, there was the real estate bubble, there's so many of them. And I have criteria to identify them, but that's me as a professional doing that kind of research to have criteria. The markets reflect the opinions. So for that reason, when everybody agrees on something, they're probably expensive. And when everything is hated and you think it's the worst, everybody, then it's probably cheap. And people confuse the fact that, let's say, a good company is not a better investment than a bad company, any more than the horse in the horse race, that the worst performing horse has odds that are much higher if he comes in. And so because of that, you have to know what to look for in those things. But I don't think that I think you have to be careful about that and diversify well, and beware of fads, But if you diversify well, it'll be easier and better. Because it's very difficult also to distinguish a fad from a new reality. Is crypto a new reality or is it a fad? Is this technology thing, a new reality or a fad? Those can be difficult to decide. So, go back to the diversification. There's a technology, the blockchain technology, which I think is an excellent technology. And I think it's very important to distinguish it from a digital currency. And if we're dealing with digital currencies, let's use Bitcoin as an example. There are all sorts of things. There's stable coin and blah, 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 all sorts of things. But by and large, let's talk about Bitcoin. Now, first of all, I believe we're in an environment in which we're creating a lot of debt and money, and the money as we know it, and financial assets such as debt assets, which is just a commitment to receive a lot of money. I think we're in an environment that's not going to be a good environment, and people will want to look for alternative storeholds of wealth than those in terms of money. Having said that, like all the digital currencies, basically don't replicate anything. They move up and down for all. It's not like it's tied to it's inflation hedge or it's this and that. It's mostly so it's not an effective storehold of wealth. You almost have nothing to hang your hat on, and it's tiny. Bitcoin right now probably has a total value of maybe a quarter of what Microsoft stock is, and so on. So it becomes a preoccupation by people that is disproportionate with its true reality. I mean, why study that? There's so many things, so many different investments that you can study. And it's as a storehold of wealth, there's not privacy to it. There may be privacy from the public, but it's very easy. Everybody's tracking what you're doing on it and so on. So it's not private. And as a medium of exchange, it's not very effective. It's not like you can go there and easily buy stuff with it. You can buy some stuff with it, but not much. So it wouldn't be my favorite storehold of wealth. I mean, I own a tiny bit of it just because of the element of, who knows, and it could be there, but I'm not, and also to experience what it's like. But I do think that in time, there will be better digital currencies. Like I believe that you can create a digital currency that will give you the equivalent of the inflation rate. And that's buying power. Because I believe that most currencies or most debt instruments, which are, as I say, they're a promise to receive currency over the duration of them, I think that they will have poor returns relative to inflation, where I think you could get something that'll be a good digital currency, but they don't have it now. And so many things have sort of come and gone as fads, NFTs, this coin and that coin and so on. So anyway, that's what I think about it. There's a cycle. There's a short-term money, credit, debt, market, economic cycle. We call it the business cycle also. And what happens is, you go from a recession, growth is slow, inflation is low, central banks produce a lot of money and credit, it's stimulative, it's like creates that. Credit turns into debt. Debt is something that has to be paid back. Credit is something that's stimulative, it gives buying power. So it starts to create a cycle. That goes up, it leads to creating bubbles and reaching a point where there's inflation and so on. And through this process, the three main players or three main types of players are those who I'll call borrower debtors. Is it economic to borrow and be in debt? Or lender creditors? Is it economic to be a lender creditor? And of course, there needs to be the same amount of those, because one man's lending has to be another man's borrowing. But you could see how those incentives are changed by the system, because what they'll put in at the one part of the system to get it going and so on, real low, real interest rates, lots of liquidity and so on. And during such times, it pays to be a borrower, debtor. And then in these cycles, then it goes to the opposite, that it pays to be a creditor. So for example, now you have a situation where short-term interest rates are relatively high in relationship to other things. They went from giving money away for negative real interest rates to that. They changed the incentives. The action of that move from the one to the other in changing interest rates changes the value of asset classes, because every asset is a lump sum payment for future cash flow. And so the present value of that with the interest rate has an effect. And there are such things so that you can watch those. They've repeated over and over again for the same reasons. Like this cycle looks like just another one of those cycles. Essentially, we know where we are in the cycle, roughly. You're at the point where you're approaching the late in the tightening, but you haven't yet achieved that particular goal. So you know what they're going to do, blah, 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 blah. There's a lot of those things for each investment. So you have to know those mechanics.